Hello, and welcome to the latest instalment of Market Financial Solutions Conversations with Connor. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. Market Financial Solutions are a bridging loan and buy-to-let mortgage provider and are not legal, financial, investment, or tax advisors. This document is for informational purposes only and does not and should not be considered to constitute legal, financial, investment, or tax advice, or be relied upon by any person to make a legal, financial, investment, or tax decision. Therefore, investors are encouraged to seek appropriate professional advice. The opinions and views expressed in this episode are personal to the host and may not reflect the views of Market Financial Solutions. Now let's get started. Let's not beat around the bush. There's only been one thing that's been on our mind this month. The budget was delivered mere days ago, and it's already making waves. It will likely dominate the headlines for some time, and we probably won't realise the full impact of it until well into 2026. All told, though, there were just two main updates that will directly affect property investors. A mansion tax will be levied on properties valued over £2 million, which is technically a council tax surcharge, and the rates of income tax paid on rental income will rise by 2%. The silver lining here is that these changes won't come into play for a few years, so we all have time to adapt. A few other key announcements that may affect you include national insurance and income tax thresholds being frozen for a further 3 years beyond 2028, and that will gradually move more people into higher bands over time as salaries rise. And on salaries, the legal minimum wage for over 20 will rise to 4.1%. In April next year. Capital gains tax relief on shares sold by business owners will be halved. Also, English regional mayors will be granted powers to tax overnight stays in hotels and holiday lets, which mirrors existing plans in Scotland and Wales. So that will affect you if you're investing in holiday lets or staycation homes and stuff like that. Legislation will also be introduced to close inheritance tax loopholes, which includes taxing UK agricultural property that's held via non-UK entities. Of course, with these kinds of changes, we're bound to see more selling off in the property market. This creates opportunities for buyers, and we're ready to help you and your clients jump on that. By the looks of things, there will be plenty to jump on too. Nearly half of first-time buyers paused their home buying plans until after the budget, according to analysis from EXP UK. Should buyers come to the forefront as the dust settles, they'll probably be pleasantly surprised to find a lot of bargains available. Around 40% of sellers in the market are slashing their asking prices, and some are doing so by over 10%. In London's prime market, Coutts found that discounts are available in some of our most prestigious areas. In areas such as South Kensington, Knightsbridge, and Belgravia, prices are around 22% lower than their peak levels right now. These discounts may not stick around forever though, and looking at the long-term trend, it's worth getting in on the action while you can. Savills' latest forecast predicts that UK house prices will rise by 22% by 2030. It also expects rents to rise by 12% over the next 5 years. And on the rental scene, sentiment has been shifting into the positive zone in recent weeks. Keir Starmer, I expect begrudgingly, came out and said on the record that the vast majority of landlords are respectable and reasonable, and that's a word-for-word quote. Still, he said this in light of the Renters' Rights Bill, which itself received a major update in November. It was confirmed that the government will begin implementing the first tranche of reforms from May 1st, 2026. Surprisingly though, landlords at large appear to be in an optimistic mood at the moment, and there's evidence that they're already adapting to our increasingly complicated market. Just over a third of landlords surveyed said that they felt positive about the future of their buy-to-let businesses, compared with 18% in the same survey following the autumn budget from last year, from 2024. Moreover, recent research from Finnova found that over the past year, 63% of brokers reported rising demand for specialist buy-to-let products, with 75% seeing a particularly large surge in limited company buy-to-let products. Separate analysis from Pegasus Insight also showed that 1 in 10 landlords now holds a specialist buy-to-let product, which includes semi-commercial, HMO, or non-standard property loans, and over the next year, 1 in 7 expect to take out a specialist loan to support their investments.
We're thrilled to see that our market is helping property investors, and the latest data from the BDLA showed that completions across the specialist market totaled 2.5 billion in Q3 2025, up 9.6% from the previous quarter and 42% higher than the same period last year. Furthermore, applications for bridging loans grew by 11.8% over the quarter to £11.4 billion. Still, even with all these results, there is still so much more scope for growth in our market for us and brokers alike. A recent survey of homeowners found that around a fifth have never heard of bridging loans before. There's still work to be done from all of us to sell the benefits of bespoke finance. Brokers specifically need to get in on this sooner rather than later, considering the shifts that are emerging in their profession. Around 19% of brokers say they expect to retire within the next 10 years. But the number of younger brokers aged 18 to 30 who are registering rose by 10% between 2021 and 2024. There's a chance here to get some renewed vigor into our market as newcomers join. Economic data-wise, we had a bit of a mixed bag in November. Halifax recorded the fastest rate of house price growth since January in October, with average prices rising by 0.6. But Rightmove's data reveals the biggest November house price fall in 13 years, with average new seller asking prices dropping by 1.8%. Nevertheless, the official data from the ONS showed that average house prices increased by 2.6% in the 12 months to September. And housing affordability at large, according to Benham and Reeves, is set to improve for the fourth consecutive year as we move into 2026. Indeed, inflation fell to 3.6% in October, and forecasters expect a base rate cut before the end of the year. And that year end is in sight. Soon, we'll all be able to review how 2025 treated us in full and focus on our 2026 plans. I'll see you in December, where we'll have a bit of a refresh on the year's major highlights. Thank you.
If you enjoyed this episode, don't forget to subscribe, like, and share. You can access our previous episodes in all the usual places, as well as on our website at www.mfsuk.com/podcast. See you next time.